Hi guys, it's Matt Z, and I want to share with you some of the latest news that happened in the stock industry. We had an avalanche of stockbrokers going to the zero commissions model. We're going to discuss that, explore how money is made in the stock industry through order flow, and then discuss the implications for the futures industry. So guys, the commission war in stocks went to zero. We used to say that the race to zero started, and then we got here. Consumers are winning, or are they? Here are some quotes from bankrate.com. So, on September 26, Interactive Brokers brought IBKR Lite. What is IBKR Lite? So, according to them, it's a cost-effective way to trade US exchange-listed stocks and ETFs for traders who do not wish to consider their efforts to obtain greater price improvement through the smart routing system. So I started questioning, what is a routing method? What is a routing system? So I did a bit of research and found this resourceful quotes on SpeedTrader. These programs will automatically scan the various predetermined ECNs for the best price and liquidity and spread out the order until filled. Some direct access brokers go one step further and allow the users to select a preference of routes in the preferred order for their smart routing. This allows for the best liquidity situation, but may take a bit longer due to the extra time to scan the ECNs. The time difference may not be noticeable in terms of an extra second or two, but high frequency trading, HFTs, programs operate in a single-digit millisecond. Compared to HFTs, even a single second is an eternity. So essentially, in stock trading, you can choose to execute your trades on the exchange that lists the stock or stock options. About 2 weeks following the announcement of Interactive Brokers, we had 3 significant brokers announce that their commissions are going to zero. This could not be a coincidence because every customer must have called their broker with the same question, what about you? This all happened during the week of the 1st to the 4th of October 2019. So, from some of the news quotes. Charles Schwab acted as the catalyst for this latest wave of price cuts across the industry. As one of the largest and most respected brokers, Schwab announced on Tuesday that they would be ending commissions for trades on stocks and ETFs, slashing fees from 4.95 to 0 for these securities. On the option trade, it also cut its base commission from 4.95 to 0, but traders will still have to pay 65 cents per contract. TD Ameritrade followed suit later that day, ending its 6.95 commission for stocks and ETF trades. It followed Schwab move on options too, cutting its base commissions to 0 and lowering its per contract fee on option trades to 0.65. Rival E-Trade joined the fray for the next day, slashing its 6.95 commission on stocks and ETFs to 0. It also trimmed base commissions on option trades to 0 and slashes per contract fee on option trades to 0.65, matching its other big competitors. TradeStation did the same after. That week, the stocks of these companies have plummeted hard. Why? 1, loss of revenue. 2, now they are relying on the exchanges to pay the money, not their customers. We will get to the routing compensation shortly. So who instigated all of this? Robinhood. I'm not going to talk in depth about Robinhood, the app for stock trading with zero commission that was established in 2013, but Robinhood is not only a broker, but they're also an app, a mobile solution for the millennials. Were they the first commission-free brokers? No. There was another company before them called Zeco that was purchased by Ally. So clearly, zero-cost commissions gone nowhere before Robinhood showed up. But when Zeco was created, the phone used for trading was not as prevalent. And that made all the difference in the world for the success of the company, at least in my opinion. Robinhood works on a skeleton crew. This means that one person does what 10 people do in a traditional brokerage. In my opinion, again, layoffs are coming to all the traditional brokers because of the support staff, back office, and everything else. They have lost a huge chunk of their revenue. An app, by the way, is also a technology company, and they know how to scale. They can build APIs, which are hookups, and other devices that would create simple solution for trading. But Robinhood is not an asset management firm, nor is it trying to be at this point. But if one day they would, it would rock the establishment again. As a matter of disclosure, I'm not an investor in Robinhood, or do I have any financial interest in the company. So how do all those big guys and Robinhood going to make money from the free? Right? Now we have free commission. How are they all going to make money? It's called order flow. How and where your order is executed can affect the cost of your transaction and the price you pay for the stock. Here is the skinny on order flow. Basically, you're allowing big institutions to see your orders and let them place fast orders before retail orders get filled. This results in many orders being scalped for pennies or fractions of a penny. Some quotes from the famous Investopedia. So a broker can attempt to fill your orders in several ways. So now we're going to discuss all the ways that the order routing is actually getting executed in stocks. So one is order to the floor. For stock trading on the exchange, such as New York Stock Exchange, the broker can direct your order to the floor of the stock exchange or a regional exchange. In some instances, regional exchanges will pay fee for the privilege to execute a broker's order, known as a payment for order flow. Because your order is going through human hands, it can take some time for the floor broker to get your orders and fill it. Obviously, this is not the way it's done today for the most part. I had to mention the order to the floor in case some people do execute it still that way, but most of it is executed electronically, but just keep that in mind. So the next way of executing your order, it's called order to third market maker. For stocks trading on an exchange like the New York Stock Exchange, your brokerage can direct your orders to what is called a third market maker. A third market maker is likely to receive an order if A, they entice the broker with an incentive to direct the order to them, or B, the broker is not a member firm of the exchange in which the floor order would be otherwise be directed. I apologize. I have to repeat it. Sorry. Section B is the broker is not member firm of the exchange in which the order would be otherwise be directed. Okay, I hope that makes more sense. So that was the second part. Another way to route your order is through a process called internalization. Internalization occurs when the broker decides to fill your order from the inventory of stocks your brokerage firm owns. This can make for a quick execution. This type of execution accompanied by your broker's firm making additional money on the spread. Electronic Communication Network, ECN. ECNs automatically match buy and sell orders. These systems are used particularly for limit orders because the ECN can match by price very quickly. The last one is order to market order. For over-the-counter markets such as the NASDAQ, your broker can direct your trade to the market maker in charge of the stock you wish to purchase or sell. This is usually timely, and some brokers make additional money by sending orders to certain market makers, payment for order flow. This means that your broker may not always be sending your order to the best possible market maker. So the bottom line is this. Just read to you a summary of all the orders and how they get executed, and thank you to the guys in Investopedia that do an amazing job with market definition and orders and articles. So the bottom line is this, as I mentioned, stockbrokers have the ability to make a lot more money than commissions. So no free lunch still prevails. What I wanted to say is that basically after I did all my research, basically this free thing is where your order is directed somewhere, and it could many times affect the spread of your order. So although you're not paying in commissions, if you have a large order of stocks, you might get a certain spread which is much higher than you pay when you actually pay commission. So you really have to know the differences in that part. So is free trading for everyone? No. In my opinion, professional day traders that trade frequently will prefer to trade via routes that avoid slippage, narrow ranges, and other factors that would affect their execution. They will not go for this zero commission gimmick. Again, this is just my opinion. Now, Optimus Futures, we're futures brokers. Obviously, we can treat the zero commission, without thinking what would be the implication for us in our industry. So let's talk about futures and let's try compare apples to apples. So first thing, when you execute a future contract, you cannot route it to the exchange of your choice. Each exchange has one futures market. When you trade the E-mini S&P, it will go to the CME. You cannot choose, or I cannot choose, or my FCM cannot choose where to route it. They have the right to trade that contract, and that's where it goes. Now, there are contracts, for example, like crude oil, that are trading also on the CME group, but then you have other contracts in oil, but Brent, that would trade on ICE. But those are totally two different quality types of crude oil, and basically each one of them has the right to trade it. So the bottom line, the order goes to one exchange. Second thing is, there is an exchange fee. So every single exchange charges a fee for the future contract that you're trading. There's no way to avoid it. It's never free. In fact, many times the retail customers, and I understand that you want to get the best commission possible, but in reality, majority of what consists of your exchange, of your commission, may be the exchange. And the exchange is just not negotiable. You can't go to the CME and just remove it. It is what it is. For example, on the E-mini S&P, it's $1.18 today as I record this per contract. It is what it is. If you're a member or you lease a membership, it's a different fee, but for most retail, that's what it is, and you cannot go below that. Just keep it in mind when you're looking at your commission structure. It does not matter if you're trading futures on the CME, Eurex, ICE. Like I said, there's always a fee. Third, there's a routing fee. So routing fee is not something that people always see through their commission, because every FCM puts it in a different way. But essentially, a routing fee is the technology being paid to get your order to the exchange. Some broker combine it with clearing and some do not. The fee is included there, and it's up to the different brokers, or I should say the FCM, how they put it there. But essentially, whatever platform you use, there is a routing fee from the technology side to the exchange. Again, some people can include it in the clearing, some people put it in the commission, but it is there because it's a cost of the company to actually execute the order and the use of their technology. But there is one fee that you do not pay in futures, and it's very important to keep in mind. It's the leverage fee. So again, let's compare apples to apples. Let's say you have a $10,000 account in stock and you want to get some leverage. From the research that I've done, most provide 50% when you trade stocks. So your total on a $10,000 account, the most that you could trade is $15,000. If you started with a $10,000 account, well, they charge a fee for that. The fee is an annual fee, which can range anywhere from $2.75 to 5% for the use of the brokerage funds that you borrow. So let's compare apples to apples for a minute. So let's say you trade one contract on the E-mini S&P. Let's say it's trading right now around, I'm just rounding up, around the 3,000 level. So mini S&P, you're trading at a level of 150,000. So 3,000 multiplied by 50, that's 150,000. If you were to pay interest of 5% per year on that, you're actually paying $7,500 to trade it. Just think about it for a minute. You have a $10,000 account, you're trading one. If you were to get the type of leverage, that's what you would pay. So essentially, if you have a $10,000 account, you would pay 75% your account in interest payment. If you traded two contracts, then your interest would be higher than your entire account. I hope you get it. And clearly, you can also compare it not only to the account size, but you can compare it to the margins that you're actually getting. If you're getting day trading margins, then obviously you understand what a gift leverage is in terms of, I'm not saying in terms of risk obviously entails when you trade leverage, but I'm just talking from the point of paying for it, paying for the leverage, right? So futures traders provide leverage to the small trader that does not have tens of thousands, hundreds of thousands, or millions to trade stocks and stock options. They have the ability to trade larger amounts, with a smaller sum of money. Also, futures do not have the day trading pattern rule that you must have $25,000 if you want to day trade stocks. We don't have that rule in futures. So the bottom line is this: from a commission perspective, you are paying very little as compared to the amount that you're trading, and the commissions that you pay are minuscule relative to the leverage that you are getting in futures trading. At this point, I just want to remind everyone that there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. When you trade leverage, you can win a lot, but you can also lose a lot. You control a larger sum of money. This program is not about risk management, but obviously you know the importance of trading size and understanding the size that you're taking, the implications of that size, and so forth. In any case, wanted to say thank you for listening to me on this podcast. I hope I was able to explore with you some of the differences in the stock industry versus futures industry. Now you understand potentially all the ways that brokers can make money outside of commissions and stocks, things that are not available to futures traders. And on that note, I also wanted to wish you happy trading, have a great trading week, and I wish you the best of luck.